Welcome to the deep dive video update. And I always want to explain what I mean by the title of this video. Every week I do a number of different videos. At the end of the week, I go through and I look at the charts that I didn't use in any of the videos, and I put those into this video because sometimes we can get some additional insight by looking at these charts. Sometimes we don't get any additional insight because if it was that blatant, I would include them in the other videos that I do. There are also some videos that are unique just to this particular video that we use more for informational purposes. This is being prepared for Tuesday, September 3rd. I do have a thing called the SPX Investing Program. It is up and going. If you want to go check it out, there's a link below this video that will take you to the website. There's also a link to a video that will tell you more about the program. It's free for right now, so feel free to check that out, see if it's helpful or interesting to you. If you have any questions, you can send me an email. I have it listed right here on the slide. I also, as I mentioned earlier, do a number of videos each week. All of the videos that are done on a weekly basis, those are meant to supplement the daily video, which is the real foundation of the analysis that I do for the markets. Okay, the first chart that we look at, this is for information. We want to keep an eye on the VIX. The VIX is the fear gauge. When the VIX is going up, stocks are usually going down. When the VIX is going down, stocks are usually going up. Well, when the VIX was first created, it had a static range, 12 to the downside, 20 to the upside. And we still focus on that. But there are times when the VIX does not stay in that range. And what this chart does is try to measure what is the longer term range of the VIX. When the market's really going down, we go up into a higher range here. When stocks are going up, we usually shift down into a lower range. We were in a higher range after the COVID crash in 2022. Now, for the most part, we've been dropping down into a lower range. So we don't make any decisions based on this chart. This just tells us, okay, the VIX is tending to be in a lower range right now. Then we also measure the direction of the VIX, and I use an RSI based on 9 periods, a momentum oscillator, to try to determine, are we going up really fast? Are we going down really fast? And when we get to an extreme positive or negative reading, that's when I start using this in the daily videos. Right now, we're just about at the middle, so we're not really getting any additional insight from this. Another study that we do with the VIX is we look at the VIX itself, and then there's a VIX of the VIX called the VVIX, and we do a ratio between them. And in a general sense, when this is going down with this ratio, that means that stocks are usually going up. Now we continue to go lower here, even though we're flattening out a little bit, and we're not going down with any real velocity right now, since things have slowed down a little bit. Plus, at the beginning of August, we had that huge down day where the VIX just really spiked up to a level it hasn't been at in a long time. And that kind of skewed the results a little bit here. But overall, with this declining, that tends to be more positive for the market. Another study that we do with the VIX is we look at a correlation between the VIX and the S&P 500. When we get above this dashed line here, that means the market is getting nervous. And sometimes we see this with this chart, but we may not be seeing it with our other VIX studies and other VIX charts that we look at. Right now, we're getting a very low reading here. So this chart is not giving us an awful lot of additional insight, showing that fear has dropped back down and is rather low. Then we look at the volatility of stocks as measured by the VIX and the volatility of bonds as measured by the MOVE index. And we do a ratio between them, showing that volatility of both has been dropping off, especially when you compare stocks to bonds. This is not necessarily measuring direction. This is just measuring volatility. And when this drops off and is going down, as a general rule, this tends to be more positive for stocks, but there are exceptions to that. You can see when the S&P was going up, we saw this moving average going up as well. Other times when this moving average is going down, we also saw the S&P going up. So we don't want to put a blanket rule on this. We just look at it and then use other charts to give us the context as to what's actually happening. Then, just to keep an idea of where are we in relation to the previous all-time high, which was set in January of 2022, as of Friday's close, we're up 17.22% from that other all-time high. Then Stock Charts has this thing called technical alerts, and these are triggered, and I go through the daily alerts in the daily video. Well, what I look at here are all of the different alerts that were triggered throughout the week. And typically, if we're having an up day, we'll see more blue or green. On a down day, we'll see more red. And we had a solid up day on Friday because we read this from the bottom up. And so we saw a lot of green or blue here, depending on what color you see. And then other times earlier in the week when we were going down, we tended to see a lot of red. So I do focus on the individual alerts and go over those in the daily video. This gives us more of just a color representation. Are we looking more positive? Are we looking more negative? Because these alerts not only look at the S&P, they look at the Dow, the NASDAQ 100, they look at other indexes. They even include TSX, which is Canada. So we can get an idea what is the general atmosphere of the market by looking at the color here. Then stockcharts.com also has another thing. The idea behind technical analysis is to remove as much emotion as possible. So you're looking at a chart, you're looking at data, and that data should be very easy to interpret. It's either positive or negative. Well, that's not always the case. You can line up a bunch of different people and they can all look at the same chart and reach a different conclusion. Stock Charts tries to take this and quantify and qualify the technical analysis that's happening in these charts and put them on a scale of 0 to 100. The higher the score, the better looking that particular chart. Now, what I do is I use these according to indexes, and there's 5 indexes that I follow. The Dow, the S&P, which is the foundation of what I do and teach, the NASDAQ 100, the mid caps, and the small caps. And then we rank them. See what chart is looking best right now. So coming in first place is the S&P 500. It's coming in at 81.8. When a chart is looking really strong, it'll be up into the 90s. But still, when you compare it to all the other indexes that I follow, and you can apply this to individual stocks or sectors as well. I use this as it focuses on indexes. But the S&P has been holding up a little bit better. We've been chopping sideways for the last week to week and a half, and that tends to erode the technical analysis that we're seeing in that chart, even though we still remain positive. In second place, which was in last place a week ago, you can see how we really came up here. This is the Dow. These are the diamonds, which is the ETF for the Dow Jones Industrial Average. And it hit an all-time high in Friday's session, where it had been lagging quite a bit. And this is considered to be the best of the best stocks, the bluest of the blue chips, because blue chips are used in poker. And they typically mean those are the chips that have the most value. Then coming in third place are the small caps, which have been very frustrating in 2024. It looks like they're breaking out, then they stall, go back down, then they break out again, or get close to breaking out, and then they stall back. And you can see the real roller coaster ride here as we look at the score in a bit of a historical context here. But they're coming in third place at 64.8. Not a real strong score, but still ranking third this week. Then we have the QQQs, which for much of 2024, they were in first place week after week after week. Well, we were up around the 90 level now, but we're seeing the NASDAQ 100 not performing as well lately. It's actually underperforming the NASDAQ and underperforming the S&P and not looking quite as solid now. These are the mega caps. These are the stocks that everybody talks about and everybody wants to own. And this is the tech sector and areas of real growth in the market. Now they're coming in above 50, but not really looking strong now at 57.7. Then we have the mid caps, which earlier in the year, this for a few weeks there, this was the strongest index. Well, it's fallen back, and now it's coming in with a score of 55. Then we look at a short-term chart. There are times when I might use this in the daily video, but not very often. This is a rainbow, a short-term rainbow, And what are plotted here are moving averages going from 10 periods up to 50 periods. So they're short-term moving averages, and change the color so it looks kind of neat and everything. And I try to make this a longer chart to get a bigger picture, even of the short-term trend. And we're above all the lines in the rainbow, and all the lines are starting to turn back up. But we have been chopping sideways for a while now and not really breaking out, not setting a new all-time high. And there are areas of vulnerability in the market right now. We'll have to see after the 3-day weekend, and folks are going back to school and they're going back to work and they're ending their vacations. Are they going to come in and buy, or are they going to come in and sell? Because September can typically be a pretty weak month for stocks, but it doesn't mean it's always weak. There are times when September goes up. So we'll just look at the charts and evaluate things and on a day by day basis, and then see, okay, how do we need to change our position, or is it looking more positive or negative at that time? Then we also look at the short-term moving average, and this is measured a little bit differently. This is a 20-period simple moving average of the open, high, low, and close, and that produces 4 lines on here. And sometimes we use this as support or resistance. Well, we're far away from this little mini rainbow now, and we're above all the lines. So that's positive in and of itself, and all the lines are turning back up. So this also supports the idea that the short-term trend is positive. And intermediate term, have another rainbow. A little further out with the moving averages, going from 50 periods up to 100 periods, above all the lines in the rainbow. And even though we dipped back down, the lines really didn't change. So this didn't do an awful lot of damage to the intermediate term trend. And now that we're back above the rainbow, the intermediate term trend is still positive. Then this is the CMB composite, which is supposed to be a standalone system that you use. I don't use it like that. I use this like an oscillator. And earlier on in August, we were getting extreme positive readings, and that's when I was using this chart in the daily videos. Since that time, we have dropped down. We're more neutral at this point. So I only break out this chart when it's extreme positive or extreme negative. Then Connor's RSI, which is another momentum oscillator. I don't use this one all that much because even though it gyrates really pretty heavily here on a day in and day out basis, we don't see extreme positive or negative readings all that often. And that's how I tend to use this. We did earlier in August, and there was a few days I was using this chart, but since then we've dropped below this extreme reading. And so I haven't been showing it. Typically what will happen on a positive day will be above the midpoint. On a negative day, we'll be below the midpoint. And then we want to keep an eye on how far away are we from the 20-period simple moving average. This is more for informational, but this can also be a little bit of an indicator. When we start to get really far away from that moving average, a lot of times we're due for some kind of a pullback. We saw that last spring. We were getting up around 14, 15% above the 20-period moving average, and then we saw a pullback. We were getting up to that level again, and then we saw a pullback. Right now, we're not necessarily too far away from that. So if we get really high with this, we will keep an eye on it. And this kind of goes in conjunction with that, just to give you some measurements here. And I do this, so they're probably not exactly accurate. When we go back to the low that was set in October 2023, and we've been bouncing up ever since then, we're currently up 27.34% from that low, a really solid move. Now, when we started to hit things in the latter part of July, we hit the all-time high on July 16th, and then we started to pull back, and then we kept coming down, coming down, coming down. One thing that I was watching here is we were getting kind of close to that 10% level. We're at 10% retracement. Typically, we'll just see a pullback. That's usually 1, 2, 3%. Then we might see a decline, which is 3, 4, 5, 6%. Well, if we start seeing a decline at 10%, when we go 10% or more, that's considered a correction. And that actually changes the whole environment of the market. Well, we were getting down to that 10% point. We got down to 9.72% from the high down to the low that we set back on August 5th. And then we were seeing support on a lot of different charts at that point, and we were able to bounce up off of that, and we've been coming back ever since. Now we're going sideways now, but this is still looking rather positive when you look at all of this together. Then Bollinger Bands, I use these there's a lot of ways you can use Bollinger Bands. There's a whole book written about this. But the way I use it on this chart is it's a thing called the percent B indicator. And this measures when we're above or below the upper or lower Bollinger Band. And that gives us an extreme reading, and that tends to not last very long. Well, we're above the midpoint, and the midpoint's going up, so that's positive. But we're not getting an extreme reading right now as measured down below, so I haven't been showing this chart. And we want to keep an eye on the 100 period moving averages. Now, in every daily video, I show the 20 period moving averages and the 50 period moving averages. We're far away now from the 100 period moving averages. So I look at this chart every day, but there's really no need to show it because we're not really seeing all that much. This is another take on using moving averages, where a typical moving average looks backward and calculates historical data to come up with its current value, where an anchored moving average, you set it at a high or a low, and then it projects forward. When we were coming down here in July and August, we were breaking below some of these anchored moving averages, but since then we've been able to get back above them, and I haven't seen a need to show this chart just because we're above all these moving averages. Then standard deviation, there was a while that I was really showing this chart every day because we were really going up fast. And this goes back, and this doesn't measure direction, it measures speed over the last 10 periods. And when this is really shooting up, that means the S&P is going fast, either up or down. Well, we've really dropped off as the market's been going sideways lately. Then there's a couple of different ways to use this. This particular chart just looks at support and resistance. This is an Ichimoku cloud. And really all this is a series of moving averages that are shifted forward. But folks use this, and that's what you find with technical analysis. It's not necessarily finding anything that tells you what other people aren't seeing. Technical analysis is also known as a self-fulfilling prophecy because you have millions of people all looking at the same chart at the same time and making decisions. And sometimes that makes the chart actually become true. And that's kind of true with the Ichimoku cloud here, where when we were coming down, we actually broke below the cloud. That means we were breaking support, but then we were bouncing back up off of that, and now we're above the cloud. So that's one way to use this chart. The next chart looks at more of the trend. And we're looking positive here. We're above the cloud. That's one thing that I already pointed out. But we see the blue line above the red line. That's positive. When the blue line drops below the red line, that's negative. Then it's really hard to see, but there's a green line in here too that it's continuing to go up. And this is called a full study. And so with the green line going up and the blue line above the red line, this is suggesting that the trend is still positive for the time being. And we look at point and figure charts. Now, I was showing this a few times in the daily video, and I also showed it this week in the weekly video. I have a weekly version of this chart too, but there's no new green here. When it's green and it's an X, that means we're going up. When it's red and a 0, that means we're going down. Right now, everything is black, but we're seeing a lot of X's here, and that's more positive. And you can see we came back to this previous high here. This measures things a little bit differently. This does not take time or volume into account. This says, okay, when the S&P moves either up or down by a certain amount, either an X if we're going up or an O if we're going down is drawn on the chart. And it could take one day or it could take a year for that to happen. And the fact that this is going up and we're still working off of a signal called a double top breakout that was generated on August, that's really hard to see, is that 19th? This is still looking quite positive. Now, if we start to see a decline, we'll expect to see more zeros being in here, but we, of course, don't know if that's going to happen or not. If we continue to go up, then we'll see more X's that are drawn. Then we look at the S&P 100 and then look at the S&P 500 as well, because the S&P 100 are the biggest stocks that make up the S&P 500. And we're seeing a little bit of underperformance here, where the S&P 100, these are the larger caps, they've really been leading the S&P higher, and they've been going more or less in tandem with each other. What we're seeing is the rest of the S&P is actually holding up a little bit better, as we're seeing some weakness in the S&P 100. And so that just means the S&P 500 is all the rest of the stocks are actually participating in the upward move. But as we've been going sideways, and we're not really seeing any leadership from the large caps, that's a little bit of a concern to us. Now, what I just said about this chart, I really get from different charts. This is just showing, okay, are we seeing any divergences here? Not really. It's the other charts that show the weakness of the S&P 100 to the S&P 500. But for the most part, they've been hanging in there together. And we have another long-term rainbow going from 50 periods up to 250 periods. Even with the decline, the lines barely moved. And so we came down into the rainbow. Then we were able to get back up out of the rainbow without really doing any significant damage, at least on a moving average basis, to the long-term trend. And then this is a long-term oscillator called a special K. We're still above the red line and going up. So this is longer term positive. And I don't show this in the daily video because it doesn't change all that often. Then on top is a weekly chart of the S&P. In the middle is a weekly chart of the German DAX. And we see that the correlation between the top chart and the middle chart is not as strong as it had been. A lot of times we'll see stocks in Germany, which that's the biggest stock market in the EU, and the S&P performing more hand in hand with each other. They may be both going up or down, but they're usually doing it together. Well, that relationship has kind of fallen off a bit lately. Then we look at some support and resistance areas, and these are Fibonacci retracements here. We go back to the all-time high, which was set in July, and then just go to the low that was set back here in October of 2023. And we got close when we were coming down. We didn't quite hit this 38.2% retracement level, but then we were able to bounce up off of that. And until we set a new all-time high, this will still be the high on this chart. If this goes up and sets another new high, then I'll readjust the lines on this chart. All right, then some broad market measures. Now, where we look at the VIX to measure the volatility of stocks, the Vixen measures the volatility of the NASDAQ 100. So this is coming down a little bit. Now, the NASDAQ 100 is doing okay right now, but not really great. But still, as it's been hanging in there, we've been seeing volatility drop off. And then we look at a ratio between the S&P 500 and then a different ratio here with the NASDAQ 100, the Qs, to the Dow. But we're not really seeing any kind of significant correlation right now. It's pretty much neutral. We want to keep an eye on the transports. They've been improving. That's the red line that we see here, but they've been really frustrating in 2024. And when the red line's under the black line, even though they're on different scales, that means that the transports are underperforming. In a more solid environment, we want to see the transports doing better. And you can see when the red line goes above the black line, that tends to be more positive for the market. When we get into really choppy situations, that can be more negative for the market. We want to keep an eye on the financial sector as a whole, but then one area of the financial sector is the bank ETF. And even though this is not setting a new all-time high, this is still looking positive, and we're still in an uptrend here. And then we do another ratio between regional banks, which are smaller banks, and we compare it with the financial sector itself. And this is holding up. We were actually seeing a lot of weakness here. When this really dropped off, this is when Silicon Valley Bank came out with their, we're not doing so good here. And Republic Bank came out, we're not doing so good. And then it looked like we were starting to recover. And then New York Community Bank came out at the beginning of 2024 and said, we got some problems here. And we've been watching this area because the regional banks have really needed interest rates to go down. And they were planning on that. And the fact that interest rates, here we are into September now, and they haven't officially been cut yet, even though it looks like they will be cut in September, that was really producing a lot of concern for at least the regional banks, the smaller banks. Well, now, as it looks like the Fed has pretty much come out and said they're going to cut rates in September, we just don't know by how much. This has been improving, even though the financial sector is doing really well all by itself. But when you compare the regional banking ETF, it is starting to see a golden cross here with this ratio. So there is some improvement. Then we look at some rate of change charts. I just use these for informational purposes. This goes with Friday's close and then counts back 250 periods. We're dropping off just a little bit here. This is another look going back to 1980. where we came up to this blue line here, and that was causing a little bit of a concern on a longer term basis, and we pulled back since then. We're still hanging in there, but we're below the blue line. If we continue to go up with the S&P and get up to this blue line, we're going to be watching this because a lot of times you can look back and see, okay, this at least didn't always mark a reversal, but it did mark a slowdown in the S&P going higher. We want to keep an eye on bonds where we have the long-term bond ETF. That's the 30-year bond. It's actually 20 to 30 years that are in that ETF, and compare it with the S&P. We look at the longer-term correlation, the relationship between the long-term bonds based on price and the S&P based on price. And this had been really dropping off, but it's starting to show some improvement, but it's still not a really strong relationship. Then we look at a shorter term relationship here, where it was really strong for a while, but now this is starting to drop off as well. And you can look at the chart where we see the S&P going up and the price of the longer term bond going down. That's why we're seeing this short term relationship not as strong as it has been. And we look at pretty much the same thing, but we just measure the TLT. This time it's in red with the QQQs, the NASDAQ 100. And we see that their longer term correlation is not as strong. It had been stronger previously. Then on top, we have a weekly chart of the 10-year yield in the US, and we subtract the 10-year yield in Germany. And since US rates are higher, even though they've been coming down lately, we still get a positive answer here. And then we look at the US dollar index. We try to look at the interplay between interest rates and currencies here. And we can see that there's a fairly strong relationship between the two right now. As interest rates have been going down, the dollar's been under pressure, even though it bounced back up this last week. But this correlation is quite high here. Then we want to keep an eye on the yield curve. Now, we're going to really be watching the jobless claims, which will come out on Thursday. The market's really focused on that right now. And then on Friday, we're going to get the employment situation report. And that's kind of the last holdout. The employment situation has been really hanging in there. And that's why the Fed has justified keeping rates higher for longer. Well, if we see a weaker than expected report, like what happened in August, early August, the market just freaked out, thinking, oh, we're going into a recession. Everything's falling apart. The job market's falling apart. We need to have rate cuts now. And everybody was going crazy. And then you couple that with what was going on in Japan, and it created a mess that lasted for a few days. Well, we were able to work through that. And now the market is pretty much saying, no, the economy's not falling off a cliff. And everything in Japan, at least for right now, seems to have been dealt with. That's why there's a real importance on this upcoming report. Because one of the things we watch is if employment starts to get weaker. We've been dealing with inverted yield curves for over 2 years now with the 10 to the 2-year. It's been just about 2 years when we look at the 10 to the 3-month. These are the two yield curves that I follow the most. I have some other ones on here, but they're not as big of a deal. If this goes back to looking normal, both with the 10 to the 2-year, which we're getting close here, and I have a breakout chart to show you, we're still a little further away with the 10 to the 3-month. This usually begins the countdown to say, okay, are we going to go into a recession? And you have the perma bears out there and the dogmatic folks who say, yeah, once these yield curves go back to being normal again, that begins the stock market crash. Well, sometimes that's true. Sometimes it's not true. But to stay that with a dogmatic opinion that if interest rates are going to be cut and stocks are going to go down, that's foolishness. Because there are times you have to look at the context of what's going on. We went through the 2010s with the Fed keeping interest rates at zero and stocks went up. Now, that would be more helpful. There are times when we see stocks going up and interest rates going up. There are other times when we see stocks going up and interest rates going down. So we have to know, why is the Fed doing what they're doing? The context that we're looking for is right now is that the Fed will cut interest rates, not because the economy is falling apart, just because we're coming back down closer to that 2% target that the Fed's trying to achieve. And the market likes that. And that would be positive for stocks. But if something happens, some kind of economic event or an attack or we go to war, whatever, that changes the whole scenario. And if the Fed cuts rates for that reason, then that will be negative for stocks. And we saw a little bit of taste of that at the beginning of August. the market really started to go down. The Fed's going to have to cut rates because the economy is falling apart. Well, for most of 2023 and into 2024, it's been just the opposite scenario, that the Fed is going to cut rates just to help the economy do a little bit better. Now, this can always change, and that's why we keep up on these things pretty heavily. All right, then here's a breakout chart of the 10 to the 2-year yield curve. Well, we're getting close, but we haven't quite gone back. There have been times over the last few weeks, or I should say over the last month, where we've actually gone back to looking regular again, only to close down still looking inverted. And then the other one that I follow here is the 10 to the 3-month. We still have a ways to go to get back to a regular type of yield curve here. We look at TIPS, which are Treasury inflation protected securities. We compare them with 3 to 7-year bonds. Typically, when this is going up, that means there's inflation worries and that interest rates are going up. Well, now we've been dropping off here. We started to really drop off. Again, we have to know the context of why is this dropping. This was in early August. This was dropping because they thought the scenario was changing to the economy falling apart. Then they kind of sat back and went, and by they, I mean the smart money that really has the most influence in the stock market and the bond market. They went, wait a minute, maybe things aren't so bad after all. So this started to go back up, which is typically negative. We are declining again now. And if we maintain the current scenario that we have now, and this continues to fall, that would be more positive for stocks. Then same basic idea here. We look at the 1 to 3-month T-bill and compare it with 3 to 7-year bonds. It was really falling because, oh no, the economy's ending. Well, now it's flattened out a little bit here, and we're actually seeing a decline with this overall ratio between the two as we're switching back more to this positive scenario. But be aware, we could get this employment report coming out. We could get some other economic reports coming out, and that could change this over to, oh my God, the economy's falling apart scenario. Then we want to keep an eye on the 2-year yield. This has been going down, and that typically is more positive for the S&P. Stocks like lower interest rates. Higher interest rates bite into corporate profits. So this has been somewhat helpful, because usually when this spikes up and comes down, that gives short to intermediate term support to the S&P. Well, we are declining here, and that's why we're seeing the S&P within spitting distance of its all-time high. Well, if interest rates start to go back up, that could put some pressure on the S&P. Then I have a number of things called possible positive scenarios. This was really helpful back in 2022. Not as helpful now, but there's still some charts that I use every day in the videos. But these are the charts that I'm going to show you now that I don't use because they're not really telling us all that much. These are the stocks in the S&P above their 200-day simple moving average. Now, I have a different chart that I do show every day, but it's a bit of a different context with that chart. This is looking like an oscillator here when we get an extreme positive or negative reading, and we're not getting that now. We can take away one thing from this. When we're above 50, we're more positive, and that's really all we can get from this chart, so I haven't been showing it. Then that same basic idea applies to stocks above their 50-period moving average. Also use it like an oscillator, and when we're above 50, we're positive. Then to get a little bit more context, we look at the mid caps, using it like an oscillator, still looking more positive. And then the small caps, also looking rather positive, but not really telling us all that much right now. This just means we're seeing more of the stocks across the market above their 50-period moving averages, which is positive. And then we're not getting Hindenburg-Ullman here. We had one spike up here back in July. We needed to have another spike up by August 2nd. That did not happen. No matter what the perma bears tell you, there is not a valid Hindenburg-Ullman on the books right now. It was not confirmed. Now, I look at this with the S&P on top, and I use this according to the NYSE on the bottom. They might do their other little trickery things using it on the Dow or the NASDAQ or what have you. But according to this, and this is what most people look at, we did not get a confirmation here, so that's not a valid signal. So thank you. I hope you found this helpful. I hope you're having a wonderful Labor Day weekend, and I will talk to you in the next video.